We're half an hour from the open in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Avril Hong in Singapore.
Good morning. I'm David Ingles here in Hong Kong. It's Friday. We made it, well, just about a full session yet ahead. We're looking at Asian shares right now, climbing in optimism. The trade war impact may see the Fed cutting interest rates sooner than expected. You also have earnings coming out of Alphabet stronger, and also progress in tariff talks with Korea and Japan also helping lift sentiment. Now, President Trump, meanwhile, insists that his team is talking trade with China despite a firm denial from Beijing, which is demanding all tariffs be lifted. And investors expecting BYD to top Tesla on quarterly profit and also sales when it reports later today, as it targets more than 5 million vehicles this year. Good morning. Just a look at market action right now. So a full trading day before we go into the weekend of maybe aimless scrolling, looking at perhaps needless gym selfies and pictures of cats. 0.7% on MSCI Asia Pacific to the upside right now. So we are getting gains across the region. Right, we are poised, by the way, for a second week of gains across Chinese markets. We'll get to that in a moment. S&P futures are also pushing higher right now, 5,600. We'll talk more about the earnings later on. Plus, of course, optimism, progress around trade talks in with East Asia. Taiwan coming online, 2.6% to the upside. All is set for a weekly loss. Get this, though. We talk about gold, right? 3,400 thereabouts right now. We've had 16 weeks in 2025, 14 of which has seen gold climb continuously. We'll talk more about gold later on in the second hour of the China program with a very special guest. Flip the boards, please, if we can. And as you do that, just a reminder that a couple of markets in the Asia Pacific are shut, Oz and also New Zealand. Gains yet again here in the Golden Dragon Index. One stock to watch very closely today, shares of Meituan. So we've talked about the issues there around the, let's talk about competitive landscape. So this is actually one stock that has almost completely gone against the grain here. We're near 6-7 month lows. In fact, we're not there yet. We're almost, flip the boards please, we're almost at the lowest since that big bazooka multi-ministry briefing in September, excuse me, on stocks. Right, so it's looking good. We're looking firm ahead of the open today. Dollar Hong Kong and dollar China on your screens today. We'll talk more about what else to watch here, but in terms of these report cards coming through, we talked about Avril, we talked about BYD. Over 100 MSCI China companies are set to report results later today.
Yeah, it's this deluge of reports, right? 100 MSCI companies, as you say, and including Ping An Insurance, China Telecom, among the likes of BYD that are set to report. But, you know, when it comes to the clash that you talked about between Meituan and JD, note as well that all this could worsen a $70 billion rout that we've already been seeing, combined rout between the two names, right? Of course, we're also keeping a close watch on potential rate cuts, a China Economics survey, and then dollar China. Interestingly, 100-day moving average that's testing those support levels. And in terms of fierce competition, those price hikes from Temu and Shein for the US, that looks to come into effect later as well. So those are among the things that we're watching. But of course, amid all this, really about whether they're talking, the US and China.
Yeah, firm denial from one side. The other says it's happening. In fact, we did hear from President Trump earlier on talking about those precise trade negotiations with the Chinese.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later.
Beijing, though, has denied any talks on a deal with the U.S. are happening while calling on Washington to revoke all tariffs.
At present, there have been no economic or trade negotiations between China and the United States. Any claims regarding the progress in China-US economic and trade negotiations are groundless and lack factual basis.
Let's bring in Min Lo, our China correspondent. She's been on top of this story here. So, Min, we have, completely conflicting descriptions of the reality, or at least both can't be right, both can't be wrong. So what do we make of this?
Yeah, it just shows that both sides are so far apart on their views that they can't even agree on the facts. And essentially what China's Commerce Ministry is saying is that Trump is lying, and Trump is there calling the reporter saying that his reporting is wrong. And bear in mind, this comes as the U.S. is hosting the G20 finance ministers meeting, as well as the IMF and the World Bank meetings. And that's why you have these Chinese officials, including the PBOC Governor Pan Gongsheng, the Finance Minister Lan Fo'an. They are in Washington now for these meetings. So this is actually the first opportunity for both sides to have face-to-face meetings since Liberation Day. But at least from the China side, we are not hearing any talk of any bilateral meeting happening. Although Trump is saying the two sides met, he refused to say who met whom. So it's all a little bit mysterious. But again, this comes as China is demanding that the U.S. removes all unilateral tariffs. But Lan Fo'an did reiterate at the Finance Minister Summit that China still advocates for dialogue on an equal basis, and it says that this trade war is really affecting global economic stability.
Okay, just to mention as well. Let me just see. I believe we have some lines coming through Pan Gongsheng. He did speak. Oh, here we go. In fact, there we go. The PBOC Governor to Min Min's point here. So, just to reiterate a couple of things, we know most of these anyway. So, monetary policy will remain moderately loose. As Avril was just pointing out, there we are going into the weekend where, again, we're waiting for more easing coming through, and possibly that could come in the weekend. Okay, the headline has just now gone red. It's reiterating it's part of the, okay, we know that. They're going to defend global economic stability. Pan Gongsheng is also urging cooperation to keep global economic stability. And I think this is really a reiteration of China's position, overall position, that there are no winners in this trade war. Again, he is speaking at the G20 meeting, and that they're also reiterating their support and promise to continue to drive China's economy, part of which, underneath his mandate, of course, will be keeping rates moderately low, policy moderately loose. Min, let me bring you back in. Something rare took place on the Chinese media. People's Daily published in English, which is not something we normally see. What does that mean, and what did they say? Yeah, so this editorial in English is clearly targeted at a foreign audience. Yep. And essentially what this article is saying is it's positioning China as a power that is speaking on behalf of the global south, because the article made a lot of mention of Africa, of Latin America, the Caribbean, the BRICS countries, and essentially is saying that the U.S. has been weaponizing tariffs, that the U.S. has been ignoring the conditions in developing countries and distorting the reasons for its trade deficit, and saying that the U.S. has been reaping the benefits of this division of labor globally, but now it is undermining the rules that underpin free trade. So China is taking countermeasures to protect its legitimate rights and interests, but not only for itself, but really to defend international fairness and justice for the rest of the world. And the article ended with China again reiterating that it is keeping its doors open, it is willing to share its developmental opportunities with the rest of the world, and really advocating for all countries in the global south to come together to counter this global hegemony.
So, Min, that's sort of the U.S.-China framing. What about China with the EU?
Yes, this was first reported by the Financial Times, but China is prepared to lift some sanctions on EU officials in a bid to work towards a détente. And these sanctions had been put in place in retaliation to Brussels accusing China for its human rights record. And lifting those sanctions would be seen as a symbolic move that could help pave the way, perhaps, to both sides picking up again discussions of that investment pact that had been put on ice after the sanctions came in. At the same time, we know that EU has been considering potential price commitments from China on the EV front to replace those up to 45% tariffs on Chinese EVs. And again, China showed another gesture of goodwill in its retaliation against those EV tariffs. It opened up a probe into French cognac, but China has now delayed the conclusion of that probe by 3 months, easing off pressure on French producers. And this also comes as we know the EU officials are looking at a trip to Beijing in July July, again showing an indication of their willingness to travel all the way to Beijing when there was reluctance from President Xi to go to Brussels, and again, both sides leaning towards each other to counter against the impact of Trump's tariffs.
Yeah, so turning up the heat with the U.S., but maybe cooling a little with the EU. Bloomberg's China correspondent Min Min Lo for us there. In the meantime, South Korea says it's reached an understanding with the U.S. to prepare what it calls a July package on trade. And Washington says an agreement could come as soon as next week.
We had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week as we reach an agreement on understanding as soon as next week. So South Koreans came early, they came with their A game, and we will see if they follow through on that.
Bloomberg East Asia government editor John Herskovits joins us now. So we kind of have a timeline for South Korea-U.S. talks, what might come out of it. What might this package that they're talking about actually entail?
At this point, we really don't know what it's going to entail. The timeline is there. South Korea has come with some ideas of what it may want to do with helping with the U.S., something with shipbuilding cooperation. The Trump administration has floated this idea of an Alaska pipeline, taking liquefied natural gas from the top of Alaska to the bottom to ship to places like South Korea and Japan, looking for investment there. But we've seen that the tariffs have started to take a hit. South Korea is one of the first countries that reports trade data. It does a 20-day figure, and it showed that exports had decreased by a little bit more than 5%. So the country is taking a hit. It's in talks with the U.S., but these talks on the trade deal take time. It takes several months at the minimum, and usually a year or more for some sort of trade deal to go forward. Much longer than the 90-day pause that the Trump administration has put on the levies that are going to be imposed on South Korea and other countries.
Right. Now, John, just to, look at the ongoing trade talks with the Japanese, and if you could give us an update there. I think one of the headlines I did see, and maybe you could put this into context, we did hear from the Minister for Economic Revitalization talking about how they're not going to comment really on the details of what's taking place so far. So what exactly do we know?
Sure. They've had one official round in Washington on Thursday. Japan's Finance Minister Katsunobu Kato met with Treasury Secretary Bessent. They decided the readout from this was that currencies are not going to be a part of the trade deal. This is something much to the relief of Japan. The talks are going to go on. Japan is one of the first, along with South Korea, to negotiate these. And they're both under some sort of similar constraints. Both countries are worried, Japan and South Korea, that the U.S. may pressure them on their trade with China, to join the U.S. in pressuring China on trade. And this puts South Korea and Japan in a really difficult position. For South Korea and Japan, their top trading partner is China. The second one is the U.S. Japan and South Korea depend on the U.S. for security. And Japan has shown that it's not really interested in joining the U.S. on pressuring China, because this could really hurt its economy. So both of these nations are trying to get something from the U.S. They have the overall levies. They have the sectoral levies on automobiles, on steel and aluminum, which are really hurting their industries. And they also may start costing jobs in America. Japan and South Korea are manufacturers of automobiles and parts in various parts of the U.S. From May, there's going to be tariffs imposed on the imports of auto parts, which could really affect the production of South Korean and Japanese cars in the U.S.
John, thank you so much. John Herskovits, our East Asia government editor in Tokyo, for us, just with an update there, really, of what we know so far about those two separate trade talks taking place. Right, going into the open today, just about 16 minutes away here. We'll hear why, of course, coming up next as well. Hear why more of our guests expect more tweaks to the reciprocal tariffs coming through in the coming months. We'll be talking market strategy and everything in between with John Woods out of Lombard. Odier joining us in a couple of minutes. And going into the open today, counting down. And if you haven't left the house here in Hong Kong, a reminder that it's quite rainy out there. So it's cheap shoes and cancel that weekend picnic. Futures, though, are pointing to the upside. This is the China Show. Good Friday morning. Welcome back to shows. Just a reminder of the fix, which is coming up on your screen shortly, if not already. I'm going to use this as an opportunity to sneak back in the red headline out of the PBOC governor speaking at the G20 meeting, reiterating that China will keep monetary policy moderately loose. That's an indication, really, of lower rates still. And also just to mention that we are going into the weekend, so we are still on easing watch out of Chinese economic officials. Right. Now, from that, as we wrap up the week, so in terms of where we are on stocks, bonds, let's include currencies there as well. So top is the JPMorgan Vol Index on currencies. You have the VIX Index, which is blue. You have the MOVE Index, which is in yellow. On price, we're 80% back on MSCI all country from the bottom to the April 2 pre-Liberation Day top. So on price, we're almost there, not quite. But as you can see, though, right, we're not out of the woods by most measures as far as expected gyrations are concerned. Well, certainly the story is far from over. Let's bring in John Woods, Asia CIO and Asia Head of Investment Solutions at Lombard Odier. Nice to see you, John. Good morning.
Nice to see you, David.
Help me understand and differentiate noise from signal here.
Noise from signal. Well, I guess it helps to have a base case.
Okay.
And our base case is that the risk of recession in the United States remains low. Certainly growth has been revised lower, but our sense is that the US will not fall into recession. And from that, I think one can build a series of scenarios around market performance. I think we're into the first or second act of a theatre of negotiation between the United States and their various trading partners. And my sense is once we get to close to that third act, maybe in the next couple of quarters or so, clarity towards the likely implications of the tariff story will become a lot clearer. As you say, markets have bounced back dramatically, but I don't suspect volatility has gone away. I think we're still likely to have a substantial amount of uncertainty and markets will remain volatile. But if you look at this current event as a series of negotiations, a spectacle, theatre, then you can potentially see through where we are likely to land. And by the way, in our view, that's likely to be 10% on major trading partners and anywhere around 50 to 60% on China.
Right. It seems the most plausible scenario, but to your point, is we know what the worst case, well, hopefully we know what the worst case scenario looks like on tariffs. And hopefully we pull back from that edge. I think Donald Trump and the White House have pulled us back a little bit. With that in mind, and we don't know, of course, how that actually lands, what are the best opportunities right now within the sort of volatile sort of trading range-bound market?
Look, our sense is at the investment committee that it's right now too difficult to anticipate with any reasonable accuracy the likely trend of negotiations with Trump. Our sense is we should essentially hug our benchmark. Essentially, we are of a strategic weighting relative to our various asset classes, and for us, that's probably the smartest place to be. Looking ahead, I think it's almost inevitable that we will see growth downgrades. Okay, the tariff effect, even if it's at 10% for major trading partners, will likely cause growth revisions or growth revisions lower in the United States, in Europe, particularly around Asia. And in our mind, that speaks positively for core government bond yields. Our sense is that yields will tick lower once this bout of volatility has diminished. And will likely outperform. So that's an area that we are looking at positively. The safe haven currencies, yen and Swissy, are likely to outperform and certainly are as we speak. Again, protecting investor portfolios from volatility. And if you were to pick, for example, in Asia, an equity market that we think is most insulated and almost likely to benefit from this trade war, it could well be India. which has traded off a long way. I think now valuations are normalizing relative to their underlying risk-reward. But a weaker dollar obviously supports the RBI in cutting rates. Valuations have improved. And as I say, I think it stands almost alone in essentially its degree of protection and insulation from the tariff war.
Interesting. We'll have you on in a couple of more minutes here, but I want to ask you also about Japan as well, because that's also emerged as an opportunity that some other people have talked about. But before I let you go for this segment, you mentioned the yen and the Swissy. You left out the dollar there.
Yeah.
In terms of the haven currencies. Is that a structural rethink now on the dollar's role?
I think that we may be alone in holding a contrarian view that actually the US dollar has essentially normalized in terms of valuation. It was egregiously overvalued, and certainly it was back in February this year. Then the Dixie was at 110. Yeah. We're now closer to 90 or so. We've seen a very dramatic revaluation, if you will, of the dollar, which was entirely, I think, consistent with a rebalancing of valuations. So no, I don't see the dollar's position as a reserve currency under threat, which is a certain narrative in the market. Yeah. I just see valuations normalizing, and were it to fall a little lower, I wouldn't be at all surprised. For example, our fair value against the euro is 115. We're seeing around 113 and change now, so maybe a little lower before actually the market stabilizes.
Okay, John Woods will be staying with us here, of course, in the next couple of minutes. Right, going into the open today, we're coming into just under 6-7 minutes away from the opening bell, and we are pointing higher, and we are on track still for a second weekly gain across these equity markets in China, and I believe also globally. Plenty more ahead. This is The China Show.
Welcome back. You're watching The China Show. Let's take a look at how futures are faring in the U.S. Looks like adding on potentially to what we've been seeing in terms of the recovery in U.S. stocks overall. We had some of these Fed officials signaling their openness to cuts if the job market deteriorates. That's feeding through into the Asia Pacific, looking quite bright as well. Flip the board, take a look at how we are faring in the pre-market in Hong Kong. Of course, yesterday we saw tech kind of taking a little bit of a beating. No thanks to all that competition. Competitive landscape for some of these Chinese tech names, including the likes of Meituan. I think it's off to a 7th week of losses, potentially down also in the pre-market at the moment. Dollar China hovering near 7.29. Of course, we heard from the PBOC governor earlier talking about keeping things moderately loose. That's to come. A lot more ahead. This is Bloomberg.
Good Friday morning and welcome back. You're watching The China Show. We're going into the open. Shanghai, Shenzhen, and here in Hong Kong, uneventful fix. Some lines coming through from both, by the way, the Chinese finance minister and the PBOC governor, effectively reiterating China's stance there on the trade war. It's a no-win for anybody, and that they will remain supportive of growth and supportive of the economy. And speaking of here, Avril, before we get to the open here, so I think it's interesting. So Meituan is actually coming off a little bit. So you have a lot of these sort of idiosyncratic corporate stories getting priced into the market, which I think is a good thing. That for once, I can't remember the last weekend, we were able to at least carve out some mind space to talk about other things but tariffs.
Yeah, something else to talk about, right? It's really about earnings, giving us something to kind of be a driver for the markets amid all the uncertainty. But it's still about those U.S.-China trade talks, Dave. I mean, are they talking? And if so, at what level? Yes, they can't even agree on that. And then watching out as well for the Politburo, right? How aggressive we can expect if there's any stimulus to come. If China's playing the long game realistically in terms of stimulus, what can we expect? So you're seeing it, moving sideways still. Again, on the mainland, more or less, in terms of stocks, we did see the banks doing quite well yesterday. They were the outperformers. Don't forget, we have earnings coming up as well. Flip the board. Take a look at Hong Kong. As far as the tech competitive landscape, you talk about Meituan, right? We've been seeing it now actually bouncing about 0.5%. JD still looking quite soft, but keep in mind as well that amid the competition, the sense you get is that this could worsen that already $70 billion combined rout that we're seeing on those shares. So tech today not faring that badly, maybe a bit of that feed through from the US for the board again. The stocks that we've also been watching really closely, the EV makers amid the Shanghai Auto Show, we've been hearing about how they're tariff-proofing themselves, coming out with all these really swanky tech offerings as well. BYD stands out, and it's expected when it reports earnings to well eclipse the sales of Tesla. No thanks to Tesla's dismal performance earlier in the week. But flip the board, I wanted to put things into further perspective for you. Take a look at this chart, which shows you the competition not just between BYD as well as Tesla, but BYD and Xiaomi. Since their share offerings or the share sales earlier in the year where they raised a lot of money, we've actually been seeing their share performance diverging. So BYD on the up and up. This is, of course, China's #1 automaker. Xiaomi going the kind of other direction. So it also gives you the sense that when it comes to China's tech rally, and I think this is the point that Bloomberg Intelligence has been making, that it's built on weak fundamentals and that for the earnings outlook, there's still going to be these tariff risks. Dave?
Yeah, I mean, the markets look ahead, and there are lots of moving parts that we sort of have to get our head around that are going to happen in the future, almost agnostic of what happens in the current timeline. Things like, you're getting downgrades to growth. So you will inevitably get an earnings downgrade cycle 3 to 6 months. A lot of the sell side have told us that do expect some downgrades on earnings expectations, not just in the next few weeks, right? In 1 or 2 more quarters after we're done with this. But that's looking into the future. John Woods is here with us in the present to help us make sense of all those things. Asia CIO and Asia Head of Investment Solutions at Lombard, Odier. Those are almost inevitable that, to your point, we will get earnings downgrades down the roads. Can we just look through that, you think? I mean, in other words, are you happy with current valuations as things stand?
Well, certainly valuations are normalizing in developed markets, and I think not before time. The United States, I think, was egregiously rich, and this sell-off in the last I guess the last couple of months or so, has normalized valuations to a point where risk-reward becomes a little more sensible. And my sense is that, once we have looked through the tariff crisis, the underlying catalysts around the United States, and we saw an indication of that from Alphabet last night, yes. The underlying catalysts, I think, will once again consolidate and gain momentum. In the China story, I'm not so sure. China is really suffering, I think, at the very basic level from a profound economic challenge. And from that, much of the issues around the equity market flow. Once I see the retail investor coming back in size, I'm just going to develop a little more confidence. Once I see the national team actually stepping back from purchasing risk, I would develop a little more confidence. But the underlying basics around the China investment story are still somewhat suspect to me. And one of the reasons why we never bought into this rally, we felt it was essentially based on
the DeepSeek rally, you mean?
Yeah, okay. Yeah. And more broadly, the China rally.
Since September, okay.
And the extent to which those gains were surrendered in an extraordinarily rapid and short period of time, I think bears testament to that. Again, I'm not prepared to go overweight China until I see some underlying foundations and building blocks developing, which will lead, I think, to improved consumption. In my mind, that's the critical key to buying China.
Okay, so not really looking at China, but when it comes to the US, we've been looking for these earnings cues, right? And we're seeing increasingly these companies are dropping guidance. It feels a lot like the early days of the pandemic. I mean, what are you using as your North Star for guidance?
Well, I mean, I think that the market is looking through guidance right now, as you correctly pointed out. The market is looking at the potential impact of tariffs on earnings in the second, third, and fourth quarter. And inevitably, there will be a hit. However, markets do price in bad news very quickly. Once we get a sense that there's at least a semblance of stability around the tariff story, and I think that even might become apparent in the second half of the year, the market will start pricing in potential gains. You know, you've got some easing by the Fed on the imminent horizon. We've seen some strong numbers from some of the tech companies underlying, I think, the value of their fundamentals. So actually, in my mind, the repricing of the US is simply normalizing value to a point where risk-reward becomes viable. Once again, it was too expensive previously, and now I think it's getting to a point where we can look at it in a much more sensible way. So it's been a very painful, jarring repricing, absolutely. But my sense into the second half of the year, we would start to see some stability. Let me conclude with this point. If you were to tell me that the S&P ends higher at the end of the year from where it is now, I wouldn't be at all surprised.
What about Japan? How are you viewing that market?
I think the medium-term and long-term story about Japan is just extraordinary. In many respects, what we are seeing is a consumption-driven economy, and we've not been able to say that for 20, 30 years. It's driven by wages growth, it's driven by an uptick in corporate revenues and ultimately corporate earnings. And I think over the medium term, that's a good story. We've got an extraordinary amount of volatility, however, about where the tariffs settle. Clearly, if we do have this 20-25% tariff on autos, on semiconductors, it's going to have a profound impact on Japan, and I suspect they will literally go into the negotiations with every intention to try and negotiate away that impact as much as they can. So the short-term picture, we think, is opaque. And until we get a sense of how those tariffs are going to play through, I think we will remain at our neutral weighting. But as I say, beyond that, the medium and longer-term picture, in my mind, looks so much more positive.
I think central banks are also watching out for these tariffs and how they're going to progress. How do you think the BOJ is viewing this? What does it need to see in the contours of this trade war in order to resume hiking?
Well, look, I think from a top-down perspective, tariffs are deflationary. I think over the very, very near term, you will see an inflation spike. And we certainly, for example, expect that in the United States as these tariffs start to boost prices. But the underlying growth effect is clearly deflationary. And to that extent, I think central banks have the flexibility to tilt towards a more dovish stance. Certainly you will see that in South Korea. They posted a contraction in Q1 growth. So I wouldn't be at all surprised if select central banks around the Asia region start to cut. To the BOJ, to your question, well, obviously it's been battling inflationary pressures, but as I suggest, if the tariffs do start to bite, start to take effect, even if it's 10%, that will have a deflationary impact, in my mind, pushing down inflation, allowing them to at least stabilize, at least move to a pause on their monetary policy.
Yeah, and I think just to bring in the point you're making, BOK, RBI, Bank Indonesia, BSP are some of the inflation-targeting central banks. If they're going to cut more, and it seems like that seems to be the case, because the inflation story, to your point, only seems to be a U.S. story, at least for now, sticky. Does that make me lean into fixed income, that side of the, this side of the world? And what does it mean between sort of dollar and local currency debt for income investors?
I think so, David. I think the fixed income story starts to gain traction, particularly if we see surplus capacity from China being exported, I daren't say the word dumped, but exported to Southeast Asia en masse. That clearly will have a deflationary impact, a decelerating a growth impact on local economies. And indeed, they're extremely concerned about that. I was just in Thailand and Indonesia, and that clearly was a front of plate for many of these economies, the likely effect of a surge of cheap goods. So yes, deflationary impact, lower interest rates, and therefore positive, I guess, ultimately for fixed income.
John, fantastic to see you. Have a great weekend ahead. John Woods there, Asia CIO and Asia Head of Investment Solutions there at Lombard Odier. Right, just ahead here on shows. So we ended at note on central banks. We're continuing it with the ECB and really this tilt dovish coming out of officials there, looking to enact a more nimble strategy, perhaps even a larger cuts? Could that be on deck? A lot of question marks. We'll fill in the blanks just ahead. This is the China Show. Good morning.
It wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward. If the big tariffs in particular come back on, I would expect more rate cuts and sooner once I start seeing some serious deterioration in the labor market.
It is a markdown. There is a markdown, but it's important to say it's a markdown from a growth rate around 0.9 to a little bit less.
Fed Governor Chris Waller and ECB Chief Economist Philip Lane talking about the impact of U.S. tariffs.
Yeah, in fact, let's continue that, because you have the ECB governing the council members that are preparing to discuss a plan to change monetary policy strategy overall. That's really to enable a potential faster response in the event we get to price shocks. Now, in fact, sources say that one of the plans will be debated at an informal retreat in early May. In fact, let's bring in Mary Nicola, our MLive strategist, to talk us through this. And, Mary, I guess there are two parts of this. We should not be surprised that most, if not all, central banks are now leaning dovish. But is the new information coming out of the ECB this week something that opens up more tactical trades, if you will?
I think the main thing here is that the central banks are just preparing themselves for what could be a big disruption in monetary policy. Whether you have it on inflation, we already know they're marking down growth and they're worried, but also it's the implication on inflation, which for the ECB is an inflation targeting central bank. So they need to be prepared, and they don't still know what the implications of the tariffs are. Is it in fact transitory, or is it something longer lasting? And remember, they don't want to repeat the same mistakes that happened during COVID, where during COVID for a long time they were in team transitory, and so they didn't, and you can argue that both the Fed and the ECB waited a little bit too long before they started to hike rates. So I think they're just trying to ensure that they avoid the mistakes, and given the highly volatile environment that we're currently in and the headline risk, they just want to prepare themselves for what could come.
So what would that sort of preparation look like, and avoiding mistakes? What would the new ECB, framework sort of be?
So that's still unclear in terms of what they could potentially do, because they still have a wide array of tools that at their disposal. Remember, they could you could do something on bond purchases. There's still something in terms of, like, what if you have a flexible inflation target, which was something that the Fed had talked about. So that's still unclear. But the main thing here is that they want to make sure that they have enough avenues open to them, and to make sure that they are ready for whatever is yet to come. Because remember, if you look at some of the forecasts that we're looking at and some of the downgrades that we're looking at in growth, for example, in the IMF, a lot of the what were growth and the expectations of growth is comparable to what we saw during COVID. And remember, during COVID, we had 80% of the global GDP just all of a sudden just shut down overnight. So if that is what the policymakers, global policymakers, are anticipating, then policymakers like the ECB or the Fed just want to be very fully prepared.
That's a great point. I mean, looking back to some of the past crises, right, for a template on how to react. Mary Nicola, great stuff. Thank you for coming in and sharing your insights with us. Mary Nicola, our MLive strategist for us there. And of course, as Mary was mentioning, when it comes to the IMF trajectory, talking about the impact of tariffs on regional economies, the IMF's Asia and Pacific Director Krishna Srinivasan joins us later on Insight with Haslinda Amin, coming up on The Times on your screens. This is Bloomberg. taking a look at some of these EV automakers and how they're faring in trade, we've been seeing NIO really outperforming for much of this week, 5% higher. And of course, against the backdrop of the Shanghai Auto Show, it's really about how some of these companies have been trying to tariff-proof themselves, along with some of their product offerings. Bloomberg's EV supply chain reporter, Danny Lee, joins us now from Shanghai. So, Danny, I know you've been at the auto show, but talk to us first about when it comes to, BYD and potentially how it's going to comfortably be able to eclipse Tesla in terms of sales. What does this mean for the road ahead for China's #1 automaker?
Yeah, BYD is in a pretty strong position here after already a strong start to the year. So that has fed into higher earnings, and particularly as it's guided towards more outsized gain on net income in the first quarter compared to the previous year. And so this means that for the first time on a quarterly basis, it will eclipse Tesla, not just on revenue, but also on profitability. And that really does come amid Tesla's weak first quarter start. So it's a strong start, and particularly very important as BYD gets out of the gates early in order to chase after the bigger target in the year ahead. And so it's very important it has that financial firepower in order to be able to chase some of its more globalist ambitions.
Danny, you guys have been covering the auto show all week, and I'm curious what your takeaway was from your conversations you've had there, and how does that go into, I think part of where I'm going with this is also what sort of guidance do you think we should be looking ahead to for an industry bellwether like BYD in light of context on the ground?
Yeah, it's fascinating that for BYD, a lot of the framing for them around some of the model launches was about premiumization, the more expensive models that they want to display, whether it be luxury SUVs to sports cars. So they've been very deliberate in highlighting that they want to be more than just this old image of them used to be able to sell to the mass market cheap, affordable cars. They want to be able to sell at much higher prices. And so therefore, it was all about the expensive cars that they had on display, not too much about the kind of other mass models that they have been refreshing. And then when you see some of the other automakers, the Western automakers in particular, one of the things that I found fascinating at the show and what the discussions we've had is that they are able to make that leap forward in terms of catching up to some of the Chinese rivals. Still, they have a long way to go, but we are able to see some of the fruits of the progress in terms of trying to be very much in the China market and trying to stand a fighting chance against the likes of BYD, who are continuing to advance ahead with a lot of new products that they've put out, BYD has, such as super fast charging.
You talk about fighting chances, Danny. The other company that we've been watching is Nissan, seeing a $5.3 billion loss. These restructuring charges are mounting. What gives, and what's your sense of how this is all progressing?
Well, for Nissan, this should not be a surprise, the largesse of losses, the write-downs and charges it's taking, because I think that the street's view of this was its real struggling performance. We will yet to see the worst of that, and under the new leadership, under the new CEO, he's very much cleaning house, trying to have very much a fresh start in order to really zero in and focus on trying to turn around and actually just save the company, because it is in a dire situation. And the big question remains for such an iconic Japanese brand is, where does it go from here in terms of the partnerships it tries to forge, if it indeed can find one, or how does it try to stand on its own 2 feet? And particularly in the likes of China, where there is such intense competition, we did see Nissan try to put a floor under some of the flagging performance it has had in a critical market, and with the extra investment it has announced in the China market. But clearly, to the broader narrative, it really is trying to survive and stay on its own 2 feet in the longer term.
Danny, thank you so much. Nissan, as you can see there, 3.3% to the upside. Danny Lee in Shanghai for us. Right, let's stay on cars, and have a look at Leap Motor here. So, a couple of reports coming through. Let me just highlight the Reuters report here that the company is in talks with Falali to develop an EV model, which is something similar that the company is already, the company is already in a deal with, as far as FAW is concerned, an EV platform there for Hongqi. But yeah, so are we going to get a sort of Tesla Tesla-esque Testarossa. I don't know. We'll see. Tesla meaning the magnetic flux, not the car brand there. Zhou Daifu is down about 4%. You had fourth quarter retail sales coming in down, and of course this is also a sort of a luxury weakness story coming through. So I would imagine this is also playing out not just with the company itself, but with some of the other proxies here listed in Hong Kong, like Lukfook, for example. So I think more on that in a moment here. Asia chip stocks, what are we seeing there? And we did get confirmation coming of Intel as far as what their plans are with the job cuts are concerned. Asia Pacific Semiconductor Index, though, is on the way up, which is really, again, stripping away the earnings story for now. This is really a macro bunch we're seeing across risk assets, almost across the board there. So we are on track for a weekly gain, a decent one. In fact, we are gaining somewhat more momentum in the last couple of minutes here across these equity markets. On that very point, let's please have a look at China A50. Well, the Chinese equities, and the reason I mentioned A50 futures, case in point, right? A50 futures in Singapore are actually on track to gain nearly every single session, every single day since the week that global-wide tariffs were announced out of Washington about 4 weeks back. So we have retraced, not all the way back, but most of those steps. On a global basis, we're up now to about 85% to pre-Liberation Day levels. Plenty more ahead here. Lots on the way here on The China Show. Happy Friday. Good morning and welcome back. You're watching The China Show. It's a rainy day, rainy weekend, in fact, projected and forecast over Hong Kong. I believe it's also the same when you look at Tokyo. John Herskovitz, who's joining us in a couple of minutes, did tell us that it has been a overcast there over Tokyo, which I guess in many ways also is an accurate description of the outlook, despite the seemingly better, relatively better compared to a few days ago in terms of the outlook for the tariff conversation. But, you know, one thing we still don't know, and this is interesting, U.S. and China, are they talking? Are they not talking? Because both seem to be contradicting each other quite clearly. More on that in a moment. We're looking at still gains though across the region. So global risk assets have actually picked up some momentum the last few days or so, and we're going into the weekend on fairly solid footing as far as that is concerned. Right now, we're speaking about earnings, speaking about corporates, and some of the lingering issues as it pertains to competition. Right. So last year it was in Change the Page, please. We talked about some of the issues in the solar industry, some of the EV plays. It's now actually playing out quite clearly with your consumption focused stocks like Meituan. We have a fantastic piece from our colleagues at BN, Bloomberg News, that have put out the amount of market cap damage that this Meituan JD.com debacle has caused investors. So Meituan, in the case of Meituan, right, we talk about how Chinese stocks are about 80% back all the way up, if not more, to pre-Liberation Day tariffs. And Meituan has gone one way. That's down. In fact, we're almost now rounding about all the gains we had from September. Yep, that's why we're trading at 128 right now. Chips are down. We don't know why, so I'm not going to pretend to know why, but they are down. We'll try and figure that out for you later on. Gold futures. Let's have a look at that, please, if we can. Gold across the board. Still some momentum coming through. So, yeah, we're going to have a very good in-depth conversation around gold. Things like, are we seeing now structurally more institutional buyers? What do we make about positioning that has lightened up from the long end so far? But yeah, price is all on the way up. Stay tuned for that. That's at the bottom of this hour. And very quickly, Asia ex-China, outside of Oz and New Zealand, which are also shut today. And by the way, I should also mention, since we talked about Japan, Tokyo CPI for April coming in, beating almost every single forecast with the exception of a few. So that is an indication, I guess, that the Japanese inflation story remains agnostic, really, of what's taking place outside. And yeah, it's BOJ, by the way. Not today, next week. I think we can worry about that on Monday. But yeah, we did hear, to the point we were making earlier on the trade confusion, we did hear from President Trump earlier, who was speaking from the White House, talking about those trade negotiations he says taking place with China.
Well, they had a meeting this morning, so I can't tell you. It doesn't matter who they is. We may reveal it later.
Beijing, though, has denied any talks on a deal with the U.S. are happening while calling on Washington to revoke all tariffs.
At present, there have been no economic or trade negotiations between China and the United States. Any claims regarding the progress in China-US economic and trade negotiations are groundless and lack factual basis.
Let's bring in our China correspondent, Min Lo, here in Hong Kong for us to talk us through that. John Herskovitz is in Tokyo to talk us through then the progress that we're seeing across the Koreans and the Japanese and the U.S. Maybe let me start with you. So we heard from the Ministry of Commerce, the spokesperson there. We've also heard from very senior Chinese economic officials in the last few hours.
Yes, so because the U.S. is hosting a series of meetings, including the IMF and World Bank meetings, as well as the G20 Finance Ministers Summit. So Lan Fo-an, the finance minister, is in the U.S. right now, as well as the PBOC governor, Pang Gongsheng. And Lan Fo-an just earlier today said that it's still advocating for both sides to resolve this trade dispute via equal dialogue, and saying that this trade dispute is destabilizing global economy. And Pang Gongsheng also saying there are no winners in trade war, and reiterating that China is going to loosen monetary policy, which means that we could see rate cuts coming. Again, timing is still a question mark there. But you heard the sound bites earlier. China and the U.S. refuting each other. China is saying there are no talks ongoing whatsoever. President Trump yesterday saying that both sides have been talking to each other daily. And today he said that both sides met this morning, although he refused to specify who met whom. So I'm still wondering, is this a pre-planned meeting with substantial talks, or is it because of those events and people being in the right place at the right time and bumping into each other during a coffee break? But it's really hard to discern what level of dialogue is taking place right now and at what stage are they talking at.
John, let's bring you in here. I mean, when it comes to talks, South Korea seems to be making some headway with the U.S. You talked to us earlier about what's at stake. Clearly, it's already eating into trade for South Korea. You're looking at the data. What is on the table between South Korea and the U.S.?
Sure. From South Korea's perspective, they're trying to get some sort of big deal. They're looking to help Trump with certain things like shipbuilding. South Korea is a major shipbuilder. Trump is trying to build shipbuilding in the United States. That's one area. Another thing that's been floated is a pipeline project for LNG in Alaska that would serve South Korea, Japan, and other customers in the region. This is something that the Trump administration is trying to get Japan and South Korea on board with. But the actual details of what may be involved are still being worked out. And one thing to consider with South Korea is that it has national elections for a president in June. The people who are at the table now may not be the people who are there in July, which is the date that South Korea has said when they want to see this sort of deal worked out. So a lot is still up in the air. We don't know the details, but there are some broad brush things that South Korea has brought to the table.
What about when it comes to Japan? How are things progressing? Because obviously we've been trying to look to it as a sort of template for other trade talks.
Exactly. Japan was the first major nation to have talks with the Trump administration after the broad tariffs were announced at the start of April. They've had one official round of talks in Washington today. Japan's finance minister Kato held discussions with Treasury Secretary Bessent. They announced that the currency would not be a part of the negotiations. But one concern that South Korea and Japan both have is the feeling that they may be pressured to work with the U.S. to put pressure on China with regard to trade. This is something that Japan and South Korea both are resisting. For both countries, their top trade partner is China. U.S. is second. But Japan and South Korea also depend on the U.S. as their sole treaty ally for security. So it's a bit of a balancing act for what will come up. But both are in similar situations. South Korea and Japan have started talks, but no resolution on either country for any sort of deal.
Thank you, John. John Herskovits in Tokyo for us with an update on progress or lack of it on both fronts there. Let's bring Min back, of course, along the conversations around one of the conditions that China has repeatedly said that it wants out of the U.S. is respect and sincerity. You know, the simplest things can be the most complex. What exactly does China mean here?
Yeah, sincerity, essentially it just means your actions match your words. And when the U.S. says it wants a deal, but it's still imposing maximum tariffs on China, China sees that as just incoherent. So they want to see an actual, genuine gesture from the U.S. to de-escalate before they're willing to engage. And the other thing that the Ministry of Commerce had said is U.S. needs to remove all unilateral tariffs. And this is where the U.S. has successfully anchored tariff expectations at 145%, which means they can go into a trade talk and say, we'll remove tariffs by 60% and tout it as a win. But then you get left with 80, 90% tariffs, which 6 months ago would still be unthinkable. And that's why China is saying, you are the one that initiated this tariff. You should be removing it altogether. They are not talking about meeting in the middle. They want it removed all the way. And the other thing, one of the preconditions that sources have told us that China wants to see is for the U.S. to be willing to address this view of China as a strategic rival. And imagine this, if China believes that the U.S. views China as a strategic rival that needs to be contained, then it believes that no matter what it does, whether it's cooperating on fentanyl or rebalancing trade, it really doesn't matter because these are just a pretext for tariffs. And who's to say that they come to a trade deal and months later Trump comes out with another threat that just comes out of the left field for China, especially when they already feel that they can't really trust Trump's words and his credibility is low. So that's why China's perception now is they are shifting their stance from finding out what the U.S. wants to focusing on what China needs. And that's why President Xi had made a trip to Southeast Asia. That's why they are reaching out to the EU to reach a détente. That's why there is the People's Daily article today speaking on behalf of the Global South, because if the fundamental view from the U.S. doesn't change, then maybe there's not that much point in coming to any discussion at all.
Fantastic. Min, thank you so much. Min Lo, our China correspondent there. I would highly recommend our viewers to check those pieces out. Obviously, the People's Daily, there was one that we just talked about there. The editorial in English addressed to the global audience, number 2. And I think this is something I believe we'll talk about substantially in the coming months, this coming together, even more closer together. Do we talk about a swap line between the ACB and the PBOC, this relationship between the EU and mainland China as something, and we have a fantastic step back piece, by the way, which talks about exactly this pivot that was forced, or a window was opened in that direction. Right, just ahead here on the China Show, we'll talk more about the latest tech and the latest hot new offerings being unveiled at this year's Shanghai Auto Show, Avril.
Yeah, but first, JPMorgan Asset Management joins us to talk diversification as U.S.-China trade tensions keep Asia investors on their toes. This is Bloomberg.
One of the reasons why we never bought into this rally, we felt it was essentially based on
the deep-seek rally, you mean?
Yeah, okay. Yeah. And more broadly, the China rally.
Since September, okay.
And the extent to which those gains were surrendered in an extraordinarily rapid and short period of time, I think bears testament to that. Again, I'm not prepared to go overweight China until I see some underlying foundations and building blocks developing, which will lead, I think, to improved consumption. In my mind, that's the critical key to buying China.
Yeah, that was John Woods, who we spoke to earlier on. So talking about how they're not prepared to move on China, and it's not really specifically to do with the tariffs, but nothing so far has convinced them from a fundamental basis, the return of the consumer, have we seen the national team pull back? So those are the preconditions, if you will, that John Woods has put in place before they're convinced about China. Now, where are we today relative to April 3, depending on where in the world you are, right, as far as global markets are concerned. MSCI All Country is about 80% back, so about 20% more were already there, to varying degrees, of course, depending on which benchmark you look at. In terms of measures of expected vol, so everything from VIX is still elevated substantially. I think the JPMorgan vol index on currencies is still obviously elevated. The MOVE index, which looks at expected vol in fixed income, treasuries, what have you, is still also there. So price, we're all the way back almost. Vol remains still a key question. And obviously gold has been on an absolute tear. We're now on track for I think it's a 12-week of gains in the last 14 or 14 in the last 16. Anyway, but yeah, we've only had 2 losing weeks of gold in 2025 so far. Right, let's try and make sense of all this. Let's bring in Jessica Tia, EM and APAC Equities Investment Specialist at JPMorgan Asset Management. It's nice to see you.
Thank you very much for having me in the show, David.
Yeah, it's a bit complicated, though, as far as markets go. But the good thing is we've seen a recovery this week. What do you think we've seen buying at the bottom here?
Yeah, that's correct. So actually, one thing that we should keep in mind is that narrative of the tariff in Asia is not something new. I mean, Asia being one of the biggest manufacturing hub in the world, some economies have already faced no tariff. Obviously, the magnitude of those tariffs and the pace of the implementation has been quite different. But ultimately, we believe that some economies will probably do better than others. Obviously, the more export-driven economies tend to be more impacted, while those that are mostly focusing on the domestic story tend to be more, I would say, insulated. To give you some examples, I mean, Vietnam have been probably in the biggest hit. Yep. But on the other hand, when we look at economies like India, Indonesia, the domestic story prevails. And the interesting case for us is China, because China's strategy was really to insulate from those trade friction impacts. And we have seen a lot of, already a different approach adopted for the past few years, if not decades, where China is trying to diversify even more their trade partners, their supply chain. China is not the only example. And that could explain why, actually, if you look at Chinese equity markets, they have, it has remained quite calmer versus the rest of the world. Even for the ASEAN markets, after some big drop post-Liberation Day, now we're gradually back to the level pre-Liberation Day. So that tells you that indeed this time Asia and China have prepared much more. I would say the potential impact of this tariff friction, even if it's escalating.
And ironically and interestingly enough, that was because of trade war number 1 and the pandemic that happened in between, the rejigging of supply chains. Would you then suggest as an investment thesis, would those be good criteria to use to determine which equity markets on an index level might perform better moving forward? The exposure to the U.S. is a very simple criteria.
So, no, indeed, we think it's very important to stay diversified, especially amid those heightened uncertainties. Okay. Obviously, a lot of people have been talking about the U.S. exceptionalism, and now it's coming into question. So what is interesting, I've met a couple of clients in Southeast Asia recently, and clear interest have shifted to other parts of the world. So in Asia in particular, I have seen some interest for China, for Japan, for Asia regional, like Asian income. So we think that, yes, there are plenty of opportunities to be found in this space, but obviously it's important to be selective. And with this tariff impact, we think that, these are information we cannot control, obviously. Yeah. It's really hard to have strong visibility on the medium term and what could be the next tariff level. So obviously monitoring those negotiation talks are very important. What we can control, however, is the understanding of those companies, their ability to improve their practices, to focus more on profitability, on efficiency. Ultimately, this to us is more important because this is where we have the edge. And also, ultimately, the earnings growth potential of those companies will drive the equity returns over the long term. So we focus mostly on that. So basically stay active and bottom up. That's our tagline.
And what other conviction calls do you have along those lines? Because I know you talk about Japan. Also, what do you think about India?
Sure. So India is obviously a very interesting domestic story. I mean, I won't go through those very well-known long-term structural growth themes. People may argue that it's a bit expensive, but actually we do spot a number of opportunities, for example, in the India financials, given that we see liquidity constraint being more relaxed. So it has become actually quite an interesting area of focus. But not only, India is also a great place to be when it comes to those IT services-related opportunities. So India is great. Outside of India, I would also highlight a couple of other segments where we find a lot of interest. Indonesia, the Indonesian banks, for example, have now become much more attractive from a valuation standpoint. If you look at going back to China, the China consumer story, internet stories amid the shareholders' returns improvement has been also another area of focus. And finally, Japan. I think people don't talk enough about Japan because it has been unloved and under-researched for so long, but the corporate governance revolution happening in Japan is tremendous, and to us will open a lot of opportunities, especially in the automation or digitalization themes.
And do you think that theme in Japan will be able to withstand and offset if the yen strengthens even further?
Well, actually, this is a good point, David. The yen, the strengthening of the yen is definitely bad for exporters, for tourists, like both of us. Yeah. But however, the yen is great for the local economy, for the consumers. And I think in the Japan growth stories, there are plenty of areas where we can play and to basically capture those long-term opportunities. I mentioned just before, the automation, digitalization, but even in the entertainment segment, Japan presents very unique characteristics that you cannot find elsewhere. So we think it's definitely a great place to be. And the corporate governance story is even more interesting because it will help also change the corporate mindset. It has led to a number of business reorganization and some takeover bids. So we think that Japan is definitely an area where we want to spend more time on, despite those tariff escalation.
It was very nice to see you. Next time you're in town, do pay us a visit again. Jessica Tia, the EM and APAC Equities Investment Specialist at JPMorgan Asset Management. There's plenty more ahead here on The China Show. Right, let's talk about the Fed here and the outlook for rate cuts. Christopher Waller says he would support rate cuts if President Trump's tariffs lead to higher employment. Have a look.
It wouldn't surprise me that you might start seeing more layoffs, a tick up in the unemployment rate going forward if the big tariffs in particular come back on. The smaller tariff world of 10 to 12%, most of the firms I talk to, they figure out they can deal with it. They kind of often give me this kind of formula. Our suppliers will eat a third of it, we'll eat a third of it, and we'll pass a third of it on to consumers. So if you're talking about a 10 to 12% tariff, it's not a big price hit to the consumers if that's all they pass through.
But economics tells us that tariffs in general are not good. So even if we get the smaller tariffs, does that still leave business on the sidelines and growth prospects lower?
Well, it is a tax, and it's inevitable that there's a tax. But however, I've always tried to tell people that, given the fiscal situation we're in, we need to get some better control of the budget deficit, and that means some combination of taxes and spending. It's just an argument about what taxes do you want to have to raise. So nobody likes taxes. I don't like taxes. But if you're going to get any kind of fiscal situation, get our fiscal situation under control, you're going to have some tax revenue. And there's no obvious reason why tariffs should be off the table, per se.
We have some tariffs in place, even though the president goes back and forth about other tariffs, but he put some on in March. When do we start to see that in the hard data?
Well, by taking off the April 2nd tariffs, you've postponed that decision until July. So we'll see some of the 10% tariffs and the auto tariffs. Some of that will start coming through particular sectors. But it's not likely to me that by July 1st, you're going to see really big impacts from it. You will see it, like I said, in CapEx and things like that have just been put off to the side. So you'll probably see some softening in the data, but you're probably not likely to see anything dramatic happen before we get better decision from the administration what they're going to do with the big tariff package that they initially proposed on April 2nd.
Well, what would we see first? A big rise in inflation or a slowdown in growth, perhaps epitomized by the unemployment rate?
I think you could see both of them almost happen at the same time, just in the sense of, like I said, that firms have to make a decision right away to pass through. Now, they have a lot of firms told me they have price contracts, so they're protected for a little while until they have to renegotiate those price contracts. But they're all anticipating, if particularly the bigger tariffs, they're all anticipating they're going to have to cut costs somewhere. And the easiest thing to do when firms have 65 to 70% of their costs is labor, to start shedding some labor. So you might see layoffs start to happen about the same time you start seeing prices going up.
Christopher Waller there with Mike McKee. Plenty more ahead here on Shows. Right, just to kick things off here, these next few minutes or so, an update that we understand from our sourcing here that if you haven't heard about the company itself, it's Butterfly Effect. That's the startup behind, in case you've forgotten, the AI story. Manus AI has now secured funding. We're talking $75 million in funding. You extrapolate that on what the details of the transaction, then it takes you to about $500 million in revenue. You can read about that on the details on your Bloomberg terminal already. In fact, that should be there at this point. Excuse me, in time. Right, Japanese markets going into the lunch break. Nikkei topics, dollar-yen 142, 143 last we checked, 143 and 142 and change there. There's a BOJ meeting next week. The inflation story continues to give with Tokyo CPI coming in just about across the board, whether that's headline, core, top end of the range, very close to that too. Right, so from Japanese assets, we'll talk more about these movers in a moment here, from cars to some of the big names in China, but now we're focused in on gold. Gold spots should be coming up on your screens. Gold futures should be also coming up. Bottom, you do the difference, that's your spread of about, let's call it $10 right now. Suffice to say, we've talked about gold a lot. It's done very well this year. In fact, this record-setting rally is making waves in China, stoking retail demand and just fanning just an absolute frenzy, if you will, going into this massive momentum-driven trade. Trading volumes on the Shanghai exchange, when you look at the data there, certainly underscoring this rush of retail into bling. In fact, it's now drawing to the extent, it's now drawing warnings from authorities. Let's bring in Catherine Lim, our Bloomberg Intelligence Senior Analyst, had the details for us. Yeah, Catherine, what can you tell us about this rush to bling?
Right. You know, when it comes to gold, let's not forget that the yuan weakness, it's kind of like, it's a reflection of the uncertainties that, facing the Chinese shoppers, etc. And David, what really stood out, when we talk about gold and the demand for that in China right now is that if you actually look at the latest retail sales numbers from China for the first quarter, in March, you actually saw jewelry retail sales jumping nearly 11% on a year-on-year basis. And that's compared to about just a 4% gain for non-subsidized products. And we're talking about clothing, etc., anything that's not under the government subsidies. So really, I think that's an indication, yes, a bit of that gold price increase, but, there is that underlying demand for gold jewelry. And Chow Tai Fook last night also highlighted that they're doing actually very well when it comes to their fixed price gold item that seems to be gaining traction with the Chinese shoppers. And I'm not surprised at all, given all the uncertainties. And as I've highlighted earlier, yuan weakness, real estate, it is where it is right now. I am expecting a shift into some of these gold jewelries in the near term. So, watching for that. Okay. Well, I know we're not to go shopping, and certainly for the lack of resources and for the fear of crowds, jewelry shops
In case that's Catherine, thank you so much. Catherine Lim, our Bloomberg Intelligence Senior Analyst, in case that wasn't clear. Okay, I'm struggling with my words right now, but it's the weekend is close. Let's continue the gold conversation right now, and let's bring in George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. George, a pleasure. I think it's been a couple of months since we last spoke. I'm sure you've been a very, very, very busy person with the rally we've seen so far this year, so we thank you for your time. As someone who watches this probably closer than most people and analysts out there, do you have concerns this deep into the rally? And if you do have concerns, what would those concerns be?
I'm not so sure that I do have concerns. I mean, I've got concerns about the erosion of trust in the U.S. economic management. I've got concerns about the erosion of confidence in the dollar, in the government bond market in the United States. All of those things caused by the current uncertainties over tariffs and over other aspects of economic management. The fears of recession, the fears of a possibility of stagflation, a revival in inflation, all these kind of things are causing enormous uncertainties. And I think that those are the main reasons why we've been seeing investors in the United States and elsewhere, China, obviously, from what Catherine was just saying, flooding into gold. And I think that probably makes an enormous amount of sense in the current environment.
So is this a structural shift in allocation, in your view?
I think we're starting to see gold become accepted more and more worldwide as a mainstream asset. It's so often it's linked in with the alternatives. I wrote a paper years ago suggesting that gold was the original liquid alternative because it was more alternative than most of the other things that were touted as alternatives, and it was more liquid than most of those too. And I think that gold, I think, is becoming more and more a mainstream part of mainstream portfolios. You need your stocks. It's always a good idea to have them, because when you get growth in your stock portfolio, then you're going to do very well. You need your bonds as protection. But at this stage, and I think, in fact, ever since the global financial crisis of 2008, I think the gold has taken over some of that protective capability that the bond market used to have in the face of potential weakness in equities. What people in the U.S. are worried about right now, and in a number of other jurisdictions as well, is the possibility of a significant recession and a downturn in the stock market. And gold historically has offered very, very good protection against both of those.
How would you suggest, particularly retail investors, build exposure to gold at this point?
Look, I think that, there's no bad way to gain exposure to movements in the gold price, but I think that the history of exchange-traded funds since the World Gold Council and State Street in partnership launched the first ever gold exchange-traded fund in 2004, GLD. I think that means that investors have essentially adopted the idea of ETFs as being a very good, a tax-efficient way of investing in gold, and in all respects, a very, very efficient way of doing it. For an asset to go from zero when it was launched in November 2004 to over $100 billion today, I think that suggests that investors have voted with their wallets, and I think that's what I expect them to continue to do. For most investors, it's probably the most efficient way to do it. There'll always be people who want to have the physical gold bars or coins in their own hands, and I understand that. I'm not immune to the visceral appeal of gold as well. But ETFs, I think, have earned their place in the story.
Do you have forecasts on gold right now?
It's only just over 12 months since we made a sustained breach of overhead resistance in the gold price at $2,000 an ounce, not $3,000, at $2,000 an ounce. It was only last February in 2024, February 2024. We've gone up like an express train since then. At some point, I think we are going to have something of a pause and a little bit of a consolidation while gold figures out what the next direction is going to be. Is it going to be further upward, or is it going to be some kind of a retreat? I think at State Street, I think we're looking at the possibility that gold could spend some time fluctuating in this $3,000 to $4,000 area. We were recently at 3,500. We've come back a little from that on some profit taking. But it wouldn't surprise me to see some kind of a consolidation, but I'm not expecting a significant drop in the price. And I think that while the current levels of volatility remain in markets, the current levels of uncertainty, then I think there's always going to be the potential for higher prices too.
George, just to get into, I guess, the weed of things, ironically, it's the final question here. One of the things that has been, two things that have been brought up recently from some of the people that we've spoken to. We've had a look at the data. The gold-silver ratio is one that seems to be extended well beyond what we normally see. I think it is a triple digits right now in gold-silver. What does that tell you? And the other one is we're looking at speculative long positions have actually started to taper off over the last couple of weeks. What does that also tell you separately?
Okay, gold-silver ratio. I've never really been a big fan of this. I think that the gold-silver ratio was what it was yesterday, and it is what it is today, and it will be what it is tomorrow. I don't think it tells you anything very much about the future of the gold price or of the silver price. I think they are very, very different assets. Gold has an enormous number of very protective capabilities, protection against potential inflation, protection against potential weakness in the dollar, protection against potential weakness in equities. It's a great diversifier that lends a level of diversification to a portfolio that very few other assets can match. I don't think silver does any of those things. Silver is primarily consumed in industrial applications, and I'm a little concerned about the future for GDP growth and in a whole bunch of other economies until the dust settles around this tariff issues and we get some kind of a certainty. So I'm not worried about the gold-silver ratio. I expected gold to do well in current circumstances. I did not expect silver to do well, and that's exactly what has transpired. So from that point of view, I don't think it's a really relevant kind of discussion. What was your second question, David? Forgive me.
No problem. Yeah, I'm sorry. There was a long-winded question. I want to get your thoughts on the pullback in long positioning, speculative positions on gold. And is that an indication of, I guess, to your point, weakness in price moving forward? Should they be worried about that effectively?
I don't think so, no. I mean, what speculators do is one thing. I've always believed that the best way for people to allocate to gold is as a long-term strategic allocation, not necessarily to take tactical positions. I don't think anybody's very good at actually second-guessing what markets are going to do. So I think that, so the entry point, I think, becomes a lot less significant when people are making long-term strategic allocations, either for the first time or whether they're adding to existing long-term strategic allocations. From a tactical point of view, I wouldn't know what to do here. As I say, I think gold comes into its own as a long-term strategic asset because of all of the protections that it offers. And every once in a while, gold has historically offered you performance in addition to those protective capabilities. I find protection plus performance to be a very, very compelling mantra for most of the investors I talk to, David.
George, thank you so much for the insights, and also, thank you as well for staying up in New York for us. I know it's getting quite late for you there Thursday. George Milling-Stanley, Chief Gold Strategist at State Street Global Advisors. Right, just ahead here in shows, and shortly, in fact, on Bloomberg TV on Insights with Haslinda, will be the IMF Asia-Pacific Director there to talk us through, of course, their outlook for tariffs, the impact on Asian economies. If you recall, of course, they've recently reduced their global growth forecast, I believe, to 2.8% for this year. Plenty more ahead. This is The China Show. Right, welcome back. You guys are quite lucky. That's the market look if you're long these markets. The other one is if you're curious what the latest thinking is around the Chinese economy, also quite lucky because in the last few minutes or so, Bloomberg just dropped the latest survey results in terms of where economists think things like growth, inflation will be. So growth this year, 4.2% is the current consensus. That then goes into 4% going into 2026, and I think 2027 is too far away to even extrapolate a meaningful figure. But in case you're curious, the forecast there is about 4%. The other thing we want to point out too is 4.5% we're coming off that level, so it's about a reduction of 4.3%. The other thing I actually want to point out too is forecast, and we've probably forgotten about inflation, right? Because it hasn't been a story really there. The CPI forecast for this year is 0.4%, further reduction from the previous thinking of 0.6%. And the chance of a recession happening in China over the next 12 months is at 10%. That's according to a rather small sample size of 7 respondents there. Right, so as I guess we try and muddle through these conversations and negotiations between tariffs, in fact, we don't even know if they're talking. One side says they are talking. One side says they're absolutely not talking. We're coming up against a couple of things next week. You have the Politburo meeting coming up, that session, of course, as we go into the end of April. And before you know it, it's data season, and the first one on deck will be the PMI numbers coming out at the end of this month. Let's bring in Eric Zhu, our Bloomberg economist, to give us a preview of why don't we start off with the Politburo meeting, and is there anything we should be expecting specifically there from the group?
The market's probably looking at a few things. One is what's China's stance on trade talk. So is there any hope on reach deal in short term, or they're going to stay tough? I think probably we won't read much explicitly on that from the Politburo readout, but we might read from the words. Especially, I think in the first paragraph, they usually give some risk assessment. So what's the risk ahead? I think definitely they're going to say this time the higher tariffs are going to deteriorate the external environment, right? So that's more pressure on the economy. But it may be tricky to read if they mention this as some, longer term challenge or just some temporary or short term, difficulty. So if it's a long term, that could signal Beijing is still very tough on this stance, right? So they're not easy. They are not willing to make easy concessions. But if they mention like a short term or some temporary thing, that might be a signal that okay, we're open to talk to you. So we want to get a tariff lower as soon as possible. So I think we might need to pay attention to those risk assessment. And second thing, of course, is what Beijing is going to do, to support domestic economy. Are they going to pump more stimulus? We don't think it's an all-in moment right now, right? So I think there's still lots of uncertainty on the tariff. Yeah, we might have some talks going, so the tariff can lower. So it's not necessary for Beijing to throw everything in at this point. But I think they will show some commitment that, if the economy sees more difficulty, we are willing, we're firmly supportive of the economy. We're willing to do more, but we're not going to do, throw everything out right now, right? I think,
show some cards, but not all of them. Yeah. How do you think the economy did this month? It's the first full month since Liberation Day.
I think Q1 is still quite robust, right? But we worry about second quarter because we have heard lots of anecdotal story that exporters who are exposure to U.S. markets, they see orders are being cut and many already suspended production. So I think we might start to see some clues from those evidence in the first April report from the PMI. But we're not sure, how big impact will be shown. It's probably still the early stage, but we do expect that the manufacturing PMI, both official and Caixin, could drop back into contraction. So that's showing some early bites of the tariff. But it's unlikely to show the full impact yet. I think from the hard data, we might need to wait a couple more months to see how tariffs, unfold.
Thank you so much. Eric Zhu, out of Bloomberg Economics there, of course, with the latest thinking. They also recently cut their forecast here on the Chinese economy. Right, what are we doing now? And just wrong timing to remove my glasses because, I'm not looking at my scripts. Returning to earnings season. We have BYD on deck today. Forecasts on the right side of your screens, financial metric on the left side, net income all the way down to, let's put it, operating costs there. Expected broadly to surpass Tesla on a quarterly net income basis for the first time when it reports results. So that's as far as the financial metric is concerned. We know as far as the volume is concerned, they're already there. BYD was also among the companies that unveiled shiny new things at the Shanghai Auto Show. In fact, Stephen Engel had a lot of fun this week checking out all the shiny new things. And he's here to take us on a tour of the hottest wheels on offer at the event.
Chinese EV makers are doing whatever they can to sort of tariff-proof their industry. Granted, they're not really in the United States market right now, but they do still need to appeal to the domestic Chinese market, the world's largest auto market. And those buyers here are very tech savvy. So these offerings, the dozens and dozens of new models on offering at the Shanghai Auto Show are laden with tech, including whatever it's doing. Those other available markets also are around the world, with countries not named the United States. This is a subcompact from NIO called the Firefly, which essentially is going to appeal to the young urban buyer. And again, it's loaded with tech. And this funky Firefly will be hitting international markets, including Singapore and elsewhere around the world, including, of course, Europe, sometime by the end of this year. Industry insiders say this little guy could be a direct competitor to BMW's Mini Electric. BYD's luxury EV brand Denza is the high end. They obviously have export ambitions. This year they're heading into Europe. This is their concept at the Shanghai Auto Show. It's called the Z Coupe. It's sort of a supercar with the wide hips, similar to a Porsche 911 or a Maserati Gran Turismo. So they're clearly going to the upper end of the sports car market, dominated, of course, by European brands. Denza Z Concept Coupe is sort of an iteration of last year's debutante, the C9, which has hit the market and is famous for its sort of crab walk parking system. Not to be confused with the strikingly similar Zeekr 007 GT. Dare I say, China is showing it is neither shaken nor stirred by the tariffs. And then there's this beast of an offering from Chinese carmaker Jetour, a division of Chery Automobile of China. It's really tapped into the growing segment of off-roading. Could this be China's answer to the Cybertruck from Tesla? They plan to bring it to market by as early as 2026, with export destinations likely in the Middle East. And finally, you know the old adage, they say that imitation is the greatest form of flattery. Well, this is Americana 1950s style on grand display from a company called Full Good from Nanjing. So maybe there is hope after all for U.S.-China relations if we could just turn back time. Stephen Engel, Bloomberg News at the Shanghai Auto Show.
All right. He had fun, didn't he? Fantastic piece there out of Steve. Subscribers can read. I didn't see the Yugo, though. Is the Yugo making a comeback? Anyway, we're going to get more on that for our Bloomberg clients. Check it out. The Shanghai Auto Show on the terminal and also Bloomberg.com. Right, welcome back. Before we wrap up the week here in the China show, just a look at markets, which by the way, are really going into the weekend with some decent momentum coming through. So where are we cross-asset globally? I think the headline just tells you everything you need to know. We've recovered on price across most, not completely, but we've done a substantial retracement back. But vol remains on the FX front, in the equity market, and in fixed income, as you can see, still well above the 12-month average before Liberation Day, a chart you want to keep in your pockets for our Bloomberg clients as we try and figure out whether or not, to what extent we've put the tariff story behind us. Certainly by no means is yes the positive to that question. Right, our new world. We're certainly in a new world right now. New world development coming up on your screens. Henry Cheng stepping down, of course, from the nomination committee, as the nomination committee chair that came out yesterday, up 7%. In the morning session here in Hong Kong. Baidu was out with some price cuts to its AI models. That's coming out also. New information there. 2 new AI models. Baidu is up 4%. And we'll wrap things up here with the show as we go into the weekend. Hang Seng Index, we are on track for the second weekly gain. Negative flows still across the Stock Connect today. We're doing very well on price. 60 minutes left in the morning session. S&P futures are also bid. We'll see you all on Monday.